Welcome back to Explain the Charts, your premier destination for insightful market deep dives. Today, August 8th, 2025, we're dissecting the S&P 500, represented by the SPY Exchange-Traded Fund, amidst a landscape of contrasting news. Just recently, we've seen reports highlighting tariffs kicking in, which immediately triggered declines across major indices, including the Dow and SPY itself. However, simultaneously, optimism is bubbling up with news of S&P 500 and Nasdaq futures ticking higher, fueled by President Trump's latest Federal Reserve Governor appointment. This push and pull creates significant market uncertainty. Amidst this, veteran analyst Tom Lee of Fundstrat maintains a decidedly bullish stance, projecting the S&P 500 to climb to 7,000 by the end of 2025. He posits that any recent market pullbacks are merely natural corrections within a robust long-term uptrend. With these conflicting narratives in mind, let's now transition to the actual candlestick charts to see how SPY's price action reflects these underlying forces and what signals it's currently sending. Starting with the most immediate picture, let's analyze the 15-minute chart, specifically focusing on the dramatic movements we observed during yesterday's trading session, August 7th, 2025. At the market open, SPY showed initial strength, pushing from around 634.99 to an intraday high of 636.98. However, this upward momentum was short-lived. Shortly after, a strong wave of selling pressure took hold, driving the price sharply down to a low of 629.11. This rapid decline strongly aligns with the news reports indicating new tariffs had officially taken effect, underscoring the market's immediate and negative reaction to trade policy changes. The significant volume accompanying this downward swing further validates the intensity of the selling. Despite the initial drop, we then saw a notable rebound from that 629.11 support level, with SPY closing the day at 633.30. This rebound demonstrates that buyers stepped in aggressively at the lower price points, preventing a more severe downturn. The 629 to 630 zone now acts as a critical immediate support level. Conversely, the previous intraday high around 636 to 637 is clearly established as short-term resistance that SPY needs to decisively break through to regain bullish momentum. Transitioning to the broader perspective, let's examine the one-day chart, which spans from March 2024 to the present, showcasing SPY's overarching trajectory. Over this extended period, SPY has largely maintained a robust uptrend, consistently marking higher highs and higher lows, reflecting a healthy bull market. However, this upward journey hasn't been without its trials, most notably a significant correction that began in late February 2025, culminating in a sharp drop in early April. During this period, SPY plummeted from highs around 610 down to a low of approximately 481.80, representing a substantial decline of over 20% from its then recent peak. This sharp reversal, seen across several daily candles with increased selling volume, aligns with reports of a worst day since May and indicates a period of strong risk aversion among investors. The candles showing long lower wicks during this April crash suggest strong buying absorption at these depressed levels, leading to a remarkable recovery. Indeed, following this deep correction, SPY demonstrated incredible resilience, embarking on a powerful recovery that has brought it back to current levels above 630. This ability to recover from such a significant drawdown underscores the market's underlying strength and the confidence of long-term investors, aligning with Tom Lee's bullish thesis. From a technical standpoint, the 570 area, which was revisited during the March 2025 dip, has solidified itself as a significant long-term support level. More recently, the 620 to 622 zone has also proven to be an important area of support, catching price declines multiple times in the last few weeks. The current resistance for SPY appears to be the recent highs around 636 to 637. A clear break above this level, ideally on strong volume, would pave the way for a retest of the all-time highs and potentially further upside towards Tom Lee's ambitious 7,000 target for 2025. While our 15-minute and one-day charts capture the most recent and long-term views, let's briefly look at the 1-hour chart, which provides a useful midterm perspective from mid-July 2025. Although this data precedes the very latest August 7th action, it illustrates the micro-trends that were forming leading into the recent volatility. Between July 18th and July 28th, SPY generally traded within a well-defined consolidation range, mostly oscillating between 627 and 631. This period was characterized by smaller hourly candle bodies and moderate volume, indicating a lack of strong conviction from either bulls or bears. The price found consistent support around 627, suggesting a base was being formed, while 631 acted as a minor resistance ceiling. Observing this hourly flow helps us understand how the market coils before making larger moves. It also shows that the price levels we are seeing tested now were previously significant areas of intraday contention. This methodical price action helped build the foundation for the eventual push towards new highs that we saw earlier this month, even before yesterday's tariff-induced pullback. To synthesize our analysis, what does this all mean for SPY in the short and long term, and how should traders position themselves? From a bullish perspective, the S&P 500's underlying long-term uptrend, clearly visible on the daily chart, remains a powerful force. The robust recovery from the significant April 2025 correction demonstrates strong buying interest on dips, which is a hallmark of a healthy bull market. Furthermore, the recent positive sentiment driven by the Fed appointment news could provide additional tailwinds, especially if it signals continued accommodative policy. Tom Lee's ambitious year-end target of 7,000, while aggressive, aligns with this underlying strength and the market's capacity for rapid appreciation. However, the bearish case cannot be ignored, particularly in the immediate term. Yesterday's sharp sell-off, attributed to the new tariffs, serves as a potent reminder of geopolitical and trade risks. Sustained tariff disputes or unexpected hawkish shifts from the Federal Reserve could easily trigger further downward pressure and increased market choppiness. The inability to hold recent highs, as seen yesterday, is a short-term bearish signal that needs to be watched closely. Recapping the vital price levels, immediate resistance for SPY lies firmly at 636 to 637. A decisive breakout above this level, ideally on higher volume, would confirm renewed upward momentum, with a high likelihood, around 65%, of retesting the all-time highs. On the downside, immediate support is found at the 629 to 630 zone, demonstrated by the strong bounce seen yesterday, which is a critical level for short-term traders. A breach below 629 to 630 would likely see SPY test the next significant support at 627 to 628, which has held multiple times in the recent past. If 627 to 628 fails, the market could seek strong long-term support around the 570 area, a key psychological and technical level tested during the major April 2025 dip. The probability of a deeper correction towards 627 to 628 is moderate, around 40%, especially if tariff rhetoric intensifies or upcoming economic data disappoints. For traders, looking for clear breakout or breakdown patterns from these levels on confirming volume is paramount for entry and exit points. Beyond price, keep a keen eye on economic indicators, central bank communications, and any further developments in international trade relations. These external factors can quickly override technical patterns. Always combine your technical analysis with a thorough understanding of the fundamental landscape. That wraps up our detailed analysis of SPY today on Explain the Charts. Remember to like this video, subscribe to our channel, and hit the notification bell so you don't miss our next market breakdown.